we take a little bit of a step back, we entered 2019 with a generic idea that all the central banks, or the US and even the ECB, were on a path of hiking rates. At the beginning of the year, we thought that the Fed would have hiked 4 times, and then ECB would have probably ended QE. Fast forward 9 months, the Fed has cut already once, and we think it's going to cut another 3 times before the end of the year, and ECB has restarted a process of quantitative easing. And as such, this reaction from reaction from the central banks are due to the fact that there has been increased perception of global recession risks. JP Morgan owns model thinks that recession, the probability of a recession has gone up from within the next 12 months from 25% to 45%, 45%. So the central banks are providing that ample liquidity, but they are doing that in an environment where you have already $13.5 trillion of negative yielding bonds, and therefore it is becoming more difficult to push that extra level of liquidity down to the final borrower. In that sense, what you can expect, we think in the current environment that you should remain overweight US equities versus US fixed incomes, and you should be overweight US equities versus non-US equities, but possibly you should also play some recession hedges via the yen, the Swiss franc, and gold. In general, as I go around the region, when I speak to investors, I would say that the biggest concerns in people's mind right now are geopolitical risks, more than lack of liquidity. The perception is there is plenty of liquidity available, but if investors are staying on the edges and not coming into the markets, is because more of geopolitical risk than anything else.
And therefore, do you think that, when you highlighted gold and other risk-averse assets, do you believe that that would also translate into more money moving into the dollar as a safer haven currency?
Well, the dollar has already appreciated quite substantially. We think right now there is not much further room for appreciation there against the major pairs. Against other currencies, against emerging markets currencies, a little bit more of a nuanced approach. For instance, if we look at INR, we think the INR could depreciate from the current level and finish the year at around 73.5, but then in a year from now could be at around 74.5.
All right, that probably will have its own peripheral impact on the equity markets. But why do you say that you should stay away from government bonds?
No, I'm not saying that you should stay away. I'm just saying that investors are finding it more and more difficult to buy negative yielding assets. And if you think at things have happened, like for instance overnight, where the Fed had injected a large amount of liquidity in the repo market overnight, which something used to be relatively normal before the global financial crisis, and then hadn't really been done for years now, and then suddenly such items have happened, more probably for a series of technical reasons, corporate tax payments, coupon payments, coupon settlements that drained liquidity in the US overnight. But there is also probably more of a secular change whereby dealers are sitting on large inventories, and there is a large amount of excess reserves on banks' balance sheet which is kept in cash.
Okay. Let's talk about emerging market banks and financials then. And is there a sense that there is some bit of risk aversion to big ticket lending across emerging markets, or that's just an India-specific issue?
So I don't know whether it's an India-specific issue. I'm not such an India specialist to be able to comment on that.
From an emerging market
standpoint. An emerging market standpoint, I think I would go back to what I said earlier. I think right now the sentiment around emerging markets is, and the sensitivity around that is more the global geopolitical risks that put people on hold on certain views rather than lack of liquidity. I mean, an easing Fed in general is a positive trend for EM assets in as such. Although we're coming towards the very end of the cycle, and therefore we would not, our chief EM strategist Pedro Martinez does not recommend investing EM as an asset class overall, but just specific peaks. One of which, for instance, is India. Brazil is another one, and so on and so forth. Indonesia is another one.
When you're looking at banking as a whole for the emerging markets, is there any specific trend that you're spotting? And do you have a broader view on Indian financials?
So, on Indian financials, we are more positive on fee-based asset managers and insurance companies kind of names than on the broader financial sector. If you take the broader banks, for instance, we probably are more positive towards the larger banks who probably can withstand some headwinds coming to in the face of the India economy better than the smaller ones. There is the problems of the NPLs and so on and so forth. But in general, for instance, if we take at India, we are generically supportive of the financials and the tech sectors in the Indian economy because they are fast growing, they are important, and for instance, they are critical for us in terms of we are investing in some of the local fintechs, corporates in India because they help us on the global payment systems and so on and so forth. In general, the Indian economy is facing, in my humble opinion, its fair share of cyclical challenges. But I would like to remind everybody that it is still an economy. It is the largest stable EM economy in the sense inflation is at around 3.6%, below the 4% government target. The current account deficit is 2% of GDP. External debt ratio is very healthy, and RBI has room to cut rates further, which should prop the economy in the second half of the year. So
time being, there could be gloom, but it's not a doom situation as such.
Absolutely not. Okay, I think right now, also if you think about what's happening with the oil, so the Indian economy is sensitive to the oil prices. When the strikes on Saudi happened over the weekend, you could see some scenarios where, in certain extreme scenarios, oil prices go to $90. But I was reading the research overnight. We believe that, given the statements from Saudi oil production minister overnight, things could be resolved rather quickly, and therefore we think that oil probably will hover around the $65 per barrel and will not go to the extremes that we had seen of $90 per barrel, which is a positive for the Indian economy.
Okay, and my last question, with regards to the recent announcement of the RBI and linking rates to external benchmarks, the new retail and MSME loans, and what does that do for transmission? I
think it's all these are all steps that go into the right direction. At times the problem of the transmission mechanism is not unique to India. It's happening in other parts of the world where you have a shadow banking system that plays an important role in the economy. For me, what I take away is RBI has cut rates already and has room to do more over the course of the year, and therefore our expectation is that the economy will grow again in the second half to probably have a 2019-2020 print overall above the 6% target.